Well, welcome everyone to this, as David said, the last Treece Talk of the year. And we're just going to do a quick review of the year and, of course, the forecasts for next year. So this is always kind of a fun thing to do. And then if you have, questions or comments, as always, you can put them in the chat and we'll get to them. Yeah, one thing, of course, as we're doing this, tomorrow is a key point where we have at 2 p.m. the announcement of whether or not there will be an interest rate cut by the Fed. We're expecting a quarter point. That market is pretty much pricing that in as like a 90% chance. So not 100%, but and that's varied depending on conditions and economic reports. But this is obviously because of concerns over a slowing economy, the unemployment situation, and the effect should be positive for stimulating the economy and the stock market. And in fact, the market is even pricing in a couple more cuts at least next year, despite the fact that inflation is still above the Fed's target. So let's do a quick review of this year because it's been a wild year. Of course, back in January, President Trump took office. And one of the things that seemed to be a surprise to the markets was the tariffs and all of his talk about, the world taking advantage of the United States. So even though the markets are up at this point, back in April, when we had what was called the Trump tariff tantrum, the stock market, the S&P 500 was down about 20% in April. So it's good to remember these things to keep a perspective as to how the markets can react. And of course, when the markets went down so low, there was a change in policy because this is what's so frustrating for many of us. Some of the market gyrations are policy driven as opposed to economics. And so here, there was the taco trade, as they call it. Trump always chickens out that he backtracked when the market went down so low. And but that's still been an issue, and it comes back and forth. So clearly, that's still an issue going forward. Our policy themes. So certainly, we had one of the biggest issues this year has been tariffs and the relationship with China. One of the things I'll point out is that we have many, like the American farmer has suffered greatly because of the tariffs and the difficulty with China. And in fact, now China is not buying American soybeans at all. The American farmer has suffered. Other places like Argentina have benefited, and this is also part of American policy. So there has been definitely another theme of the shifting American position in the world, and the, certainly what China is getting, like much of the world, away from the United States. We've seen a debasement in the dollar, a decline in the value of the dollar, and I would say the American position in the world regarding China and its exports, despite the difficulty, to put it kindly, with the United States. This is from Yahoo Finance. One of the main targets of President Trump's trade war had other toys to play with in timeout. A lot of the business, the tone of the reporting has changed noticeably. The trade war that China had other toys to play with during the timeout. China's annual trade surplus surpassed $1 trillion for the first time this year as it ramped up exports of semiconductors and vehicles to pretty much everyone but the United States. China's customs agency announced yesterday. The country hit the milestone last month, making its trade surplus for the first 11 months of the year nearly 10% higher than all of last year. So China continues to export around the world, but less so to the United States. China's exports to the EU grew by 15%, the most that they've grown in more than 3 years, and goods shipped to Africa, Southeast Asia climbed to 28% and 8.4%, respectively. So some of the policies could be, while they're intended to attack China, seem to be driving China to our allies and leaving the United States out. So that's one theme there. Another theme on the same line is, and this is just from this morning, this is from Politico. And again, I note the tone change in some of the reporting. This is the headline from Politico. And this is just as of this morning, December 9th, as we're doing this. Trump thrashes European leaders in wide-ranging interview. I think they're weak. So this was a recorded interview. President Trump denounced Europe as a decaying group of nations led by weak people in an interview with Politico, belittling the traditional US allies for failing to control migration and end the Russia-Ukraine war, which he said he would end on day one, by the way, and signaling that he would endorse European political candidates aligned with his own vision for the continent. The broadside attack against European political leadership represents the president's most virulent denunciation to date of these Western democracies, threatening a decisive rupture with countries like France and Germany that have already deeply strained relations with the Trump administration. I think they're weak, Trump said of Europe's political leaders, but I also think that they want to be so politically correct. I think they don't know what to do. Europe doesn't know what to do. And he was really, targeting them for immigration. And there's a lot of themes there: anti-diversity, equity, inclusion, and as I have said, as in other recordings, racism. A lot of these policies are blatantly racist, and and a lot of the language around it too. So that is another theme of this year. The dollar debasement, attacking allies, that Canada should be a state, referring to Pierre Trudeau as a governor, about the necessity of taking over Greenland, the Panama Canal, and now possibly war with Venezuela. So kind of these are interesting times that we live in. And another thing that I think is going to be a big ongoing theme is what we call the K-shaped economy. And the K, you think of the upward slope and then the downward slope. And this really refers to the divide in the economy between people who are doing well and people who are struggling. Again, another theme this year was the government shutdown, the longest in history. I'm going to go through what a lot of the major banks and economists are predicting, but one of the themes is that K-shaped economy, where a lot of the growth has been driven by the top of the pyramid, as I say, while the bottom of the pyramid could show signs of stress or crumbling, which then, of course, I like that pyramid example, affects the people at the top of the pyramid. Wells Fargo sees the artificial intelligence boom echoing past periods of tech-led growth. It also cautions that the trade could become a bubble. The firm argues that policy and liquidity should keep the backdrop supportive heading into the midterm election cycle, but notes that market is becoming increasingly intertwined with the broader economy. Now, think about that for a second. We've always said there's a difference between Wall Street and Main Street, between the stock market and the economy. Sometimes we get bad news for the economy and the stock market goes up. And it has to do with, for example, an expectation of interest rate cuts. So here to continue, quote, a K-shaped economy led by wealth effect means a bear market could trigger an economic downturn, which neither the Fed nor the government can afford, especially into the midterms. The bank's equity strategy team wrote. The firm noted that equity gains have become increasingly tied to household wealth as the economy splits between the haves and the have-nots. So we see this statistically as well. The stock market is great for those at the top who've been invested and are able to benefit from it, but others are not. But then getting to some of the specific forecasts. Here is, and again, I'm going to caution on this because these forecasts are generally mostly wrong, and they generally go to an average. They will say, oh, the stock market will be up 8 to 12%, that kind of a thing. One interesting fact is that very often the stock market, when it's up a lot. When it's down a lot. So it's not like in 2022, the NASDAQ was down 30%. So it's not, the stock market does not necessarily just go to an average, but a lot of the forecasts do. So here, the forecast, the lowest is currently from Bank of America, which is predicting just 3% growth in the stock market, the S&P 500. And at the other end, you have Deutsche Bank, which sees a 16% growth. So we don't have anybody who's predicting a recession, a contraction, a down market in the stock market. But the forecasts are from positive 3% to positive 16%. And again, in the middle, you have several banks at 8%, at 9%, some at 12, 13, and 14%. Morgan Stanley and Wells Fargo at 14%. But of course, there is always risk. And one of the other interesting things to look at is the stock market can be volatile in midterm elections. And so that's something obviously we have this coming year in November. And some of the policies may be driven towards trying to create a certain election result. So specifically, I just gave you some of the ideas on what the forecasts are, but then what are the reasons for some of these forecasts? And again, you take them with a grain of salt. There's some people I actually make fun of because I think they are typically so far off, sometimes 20% off. And so again, nobody knows. That's the one thing. So here's some of the Wall Street's views on the stock market for 2026 and why they're making these forecasts. One, revenue should benefit from economic tailwinds. Economic growth isn't expected to be spectacular, but it should be bolstered by fiscal stimulus, more spending. The one big beautiful bill, as it's named, is stimulus. It's more spending. And so the spending, government spending tends to stimulate the economy, can be good for the stock market. Secondly, is easier monetary policy by the Fed, starting as soon as tomorrow. We may get an interest rate cut. This also can stimulate the economy. By the way, I've said all along, these things are inflationary. So you wonder why inflation has not gone down. Well, this is part of the reason. A trade policy that's friendlier in 2025. I just love the language here, friendlier. It's not hostile as hostile to American companies, which are actually suing the federal government over these tariffs. It'll be interesting to see how they're suing for refunds, Costco. And so if that goes their way, you're talking about billions of reimbursements somehow. That could be incredibly interesting to see how that plays out. So we have the stimulus from spending, interest rate cuts, maybe a friendlier trade policy, some economic challenges. Inflation is still expected to be above, as I just kind of mentioned, the Fed's target rate of 2%. It's possible that we could even see inflation get higher, above 3%. Nobody's predicting a recession, like a negative GDP growth. I haven't come across that in any of these forecasts. But clearly, there's a lot of risk out there. In fact, I want to say a lot of the forecasts really look at companies with strong earnings growth. 14% on average is the forecast. And it's not just the Magnificent Seven, the tech stocks, but a lot of the forecasts are that this is going to expand to the broader economy. So, there would be a reason for these valuations and for the stock market to go up. But again, the midterm, this is a key observation, just as a statistical observation about the economy and stock market in midterm election years. The intra-year drawdown for midterm election years since 1946, and I kind of like that post-war time frame, averaged 18%, which is the highest of all 4 years of a presidential cycle. So a mid-year drawdown of 18%. We had this year in April 20%, near 20%. We consider a correction 10%. 20% gets into a bear market. So corrections are normal. We typically get those kinds of a swings like 10%. But here, this is a point that the in a midterm election year, the drawdowns are the highest statistically. And in addition, the S&P 500 experiences the weakest average annual price gain at only 3.8%. And it only goes up a little bit more than half of the time, when normally it's like three out of four times it goes up. So definitely midterm election years can be tricky for the stock market. So that's basically the forecast. They are largely positive. Um, One of the questions I get a lot is about, is there a bubble? And people are afraid of a tech bubble like we had in 2000, 2001, 2002, 3 years in a row of double-digit losses. And most of the analysis is no, it's not going to be the same. There are valuations, there are earnings. Yes, will be winners and losers. Some of the investments and capital expenditures may not pay off for some of the companies, but it's not being really predicted to be generally. Of course, you always have naysayers, but it's generally not being predicted to be a bubble. This is from HSBC. It's kind of interesting. They say, "Are we in a bubble?" Bubble or not, history shows that rallies can last for quite some time, 3 to 5 years, in the dot-com housing boom. So we see more to come and recommend a broadening of the AI trade. Now, that's not very reassuring when you put these in the context. Oh, we had the huge boom before the bust, both in the dot-com bust and in the housing boom, then bust. So I think this is the concern that people have is there another shoe to drop here at some point? So, just to wrap this up on these forecasts, our feeling is that yes, there's risk out there. I don't see anything imminent unless it is news driven, like a social media post or an invasion of Venezuela, something in Europe, Ukraine and Russia. But the underlying economy still is muddling through. But we do have that K-shaped economy, and that continues. And you see that in the index of consumer sentiment. Those who have more are a little bit more optimistic. Those who have less are more pessimistic. So on that note, I'm going to turn it over if anybody has any questions and topics to discuss.
David, thank you for that. It was great to hear an overview of the economy and the market for year 2025. A lot going on. And one of the things that you do so well is explain what we could for as into the end of 2025 and then to 2026. And like you said, a lot of clients are interested in potential bubble. What would be, in particular, a worst case scenario as you look back in history and then foresee what could potentially come in the next 6 months? Like you mentioned, maybe even the midterm.
I love the question because I think people get complacent, and we like some of these things which were unthinkable when we had the tech bubble. That had not happened. 3 years of double-digit losses since 1939, 40, 41, and then we had, of course, the everything bubble in 2008. Banking crisis, housing crisis. So these things happen. And then a global pandemic. If you thought, oh, could we have 1 million Americans dead of some virus? It happened. And then we think about the political division in the United States and the insurrection and political instability. You see, well, none of these things are, it's historic. So could something go wrong? I say there's a first for everything. And, we've never had, for example, the United States has never defaulted on our debt. And, could that happen? Nobody's predicting that. But you want to think about where could there be a crisis. I definitely see such weakness at the bottom of the pyramid that could become contagious, like a domino effect. Again, it could be international events. So it's hard to predict. We talk about these black swan events when something goes terribly wrong And looking back in hindsight, you should have seen it. So again, even with the AI boom, there's a lot of concern about this being very circular in terms of the financing and uh, uh, non-traditional financing. So, for example, oh, you buy our chips, we will finance you're paying for them. Well, it's like then if one thing goes wrong, it goes wrong for everyone. And so, there's some of these things that you might not see. Of course, one of the problems we had in the housing crisis, there had been so much deregulation. And we go through these cycles, it seems like deregulation, then overregulation. And again, you look at, I think there's a lot of our political institutions are being destroyed. And where does this lead? The relationships with allies, confidence in the United States, confidence in the dollar. One thing I didn't mention, and this is another trend, a key trend for 2025, the stock market has been up, all three major indexes, especially after April. However, the gold prices have also soared. And again, these usually have some sort of a negative correlation. Gold is like for fear. And it's like, oh, I'm afraid, so the stock market's down, people go to gold. And here you still have the gold trade, going very high while the stock market is up. And I think that's a measure of fear and concern also about the value of the dollar. So there's a lot of things out there that could go wrong and seriously wrong. So again, it's nothing like we can point to that's imminent on the horizon where we're expecting, another really bad jobs report or shrinking GDP. Um, so the economy is definitely muddling through, but there's a lot out there where we're in an uncharted territory where, yes, there could be something incredibly severe that goes wrong. Now, other countries have gone through it. My husband's from Argentina, and we talk about all of the defaults and the crisis and hyperinflation, and there are things that we've not really been had here, but other countries have them. Poor Ukraine, the invasion, but life goes on, and but I mean, not for everyone, and not the same way. But yes, we could absolutely have some very serious crisis, but you'd be chicken little if you're predicting it, unless there's, a particular reason.
Right, and it's really good to look past and find those bubbles in history, like in '99 or 2021, and you've cited those as what could be. But as we look also toward something also that is related to a bubble, and that is also something you mentioned as a correction. A correction, as you mentioned, is healthy. About a 5 to 10% realistic mean for a portfolio would go down about 5 to 10%. When it comes to these healthy corrections and experiencing one, which we've had over the course of time, how do you expect investors that you work with to respond during a correction? And what should they consider about rebalancing or adding to positions?
It always depends on somebody's risk tolerance, also where they are in their personal financial situation. Like, if are they in retirement, are they taking withdrawals from these accounts? There is a mathematical principle called the sequence of returns risk. If you're drawing down from an account that's losing value because the stock market is down, you mathematically shorten the lifespan of that portfolio. So that's where we do strategies where we set up a cash bucket for withdrawals. If it is the normal correction, we typically want people to stay the course. So if we have the conversations with people, but I personally am very careful about not trying to talk somebody into taking on more risk than they're comfortable with. So that's where we may go ahead and say, despite what we think may be, a correction, we'll reduce the risk somehow. We'll make a portfolio more moderate. Of course, our strategies, I'm just the biggest believer in, and this has gone on for the longest time, where we like to work with money managers and even blend them, managers who will get out of the market. It could be 100%, it could be a certain portion, and then even blending those because they do it differently. Sometimes we've got a manager like this year, one of our managers is up twice the market. And but last year they were relatively flat. And last year, one of our managers did really well. We have favorite managers that we work with who do things differently, but there's always some risk control there that they're going to get out of the market at least to some percent. People who know me will know I'm a big believer in peace of mind, which may mean just cash in the bank, that you have your emergency money, but it may be even more than what you would need in an emergency. It's just like keeping your powder dry. We also will work with things that are fixed and guaranteed. That's typically like an annuity from an insurance company, and some of those can be like CDs, where they're for like 3 years or 5 years, and you've a set fixed interest rate, or the rate you earn is tied to an index, but you're not in the index, so there's no stock market risk. So we can add all of these things. So there are ways, and what happens when you do that is that if people know that they've got a certain risk control or guarantees something fixed, if they're taking more risk in one account, one portfolio, it makes it easier to ride out those ups and downs, saying, well, this one I can wait out because I've got all the rest here that has risk control or guarantees. So that strategy really helps overall the performance overall, where people are not getting out of the market prematurely when they shouldn't. But again, it's hard to predict. Sometimes the concern is when you have a correction 10%, that it's going to go down a lot more than 10%. Like in April, it went down 20%. And there was a specific identifiable reason for it, which was the tariff policy. If the tariff policy had not been changed, postponed, then we may be looking back, hindsight, that could have absolutely put us into a recession. That could have made the stock market still down 20%. So that's where you don't know. It's like predicting the future. As we say, nobody has a crystal ball, but that's where we try to just manage risk. And we have different ways of doing it. And we try to think of everybody's personal their time frame and their risk tolerance. So if people want us to review that, just reach out, and that's our job.
Great, right. To reach out if they have any questions. That's an important part of how we do business too. We want people to be well informed about what they have and how it works. And speaking of how things are working, we're talking about a global economy in some sense, a global market. And we have clients that like to travel. They like to also not invest their time internationally, but also their money. So with that point, we have a question from our chat. What is your view of international markets as a safe haven investment opportunity to mitigate US market policy volatility?
Safe haven is too strong, but there is no question that now the international stock markets are outperforming the United States. That has not been the case. I think that will continue. And again, that has to do with a lot of the policy orientation. People are looking to get investments outside of the United States and to get investments outside of the dollar. So we're seeing that, and there's no reason to doubt that that will continue because that's the policy. And so, yes, I think people can look at international investments. We have been adding international in some cases to people's portfolios. Um, we have people who have accounts abroad, and I've always said this. This has nothing to do with just the current. It's a form of diversification. Somebody who worked abroad, they've got a foreign pension. Then we say, leave it there. This is our personal opinion. I mean, it depends on the situation, but generally speaking, it's another level of diversification that, in terms of how interest rates affect currencies. Right now, of course, people who are trying to travel abroad, the dollar is going way down, and so things become more expensive. There are benefits to having a lower dollar, like exports being more affordable, but for travelers, or it's definitely much more expensive now. And again, I don't see this changing. It's policy driven. And if we have lower interest rates in the United States, the value of the dollar internationally will go down more. So, the short answer is yes. International investments can help with risk, help diversification. I don't think you're necessarily giving up anything on the upside. where before they were underperforming. I think international markets will still overperform the U.S.
Great, thank you for that. And I also am reminded of something else you mentioned about diversification and portfolio construction and certain percentages as well. So I know it's a unique situation, as you mentioned, for everyone. So that's why you've also offered for people to contact you for reviews and to make sure that their portfolio is where it needs to be for their expectations. That
Yep.
concludes our question and answering segment. So I turn it back over to you.
There was one question I think we missed because of the chat. Many times when the market has gone down on a trading day, bonds will go up. Can you explain that? There's basically just a negative correlation. So it's not unexpected. But what I would wonder is what's going on there, and particularly in the bond market. For example, we still see mortgage rates high, and the cuts in the Fed funds rate, which we're expecting tomorrow, that is a government rate. It is not a market rate, although it's definitely affected by that. We're looking at the 10-year Treasury as the more market-driven rate. So the it's just really the negative correlation. The that when the stock market going down, there can be a rush to safety for bonds. But again, I always want to know exactly what's going on there. Why? What are the bond valuations? Yeah, I've always felt that unlike the focus on the stock market, we need to pay close attention to the bond market. That was very much the case in April. In fact, I think it wasn't just the stock market clearly going down that caused a change in the tariff policies, but it was fear about the government bond market and that these treasury auctions would fail or that the rates would go up and meaning we have to pay even more to finance our debt. So that's definitely a risk that's out there, and that is measured, and it is known. Now, that's another thing. It's like we're not getting some of the economic reports that we used to get. They just announced today we're not going to get another one, so the Fed will not have that for tomorrow's decision. But and then of course there's political pressure, and there are political appointments, and this again is, I think, destroying the confidence in some of the information that we get. And of course, there was already a lot of skepticism and conspiracy theories out there. But here I went way off on that a little bit. But that's another theme for this year and probably for next year as well. Then on that note, I will sign off. I will shut up and just say bye, everyone. Thanks for attending.